Welcome to the Risk Manager's Corner, the channel where we simplify complex risk management concepts and make them practical. In this episode, we dive deep into multivariate random variables, one of the most important foundations for understanding how risks interact in the real world. If you've ever asked questions like, why do asset returns move together? Why do diversification benefits disappear in a crisis? This episode is for you. By the end, you'll understand how multivariate random variables work, how covariance and correlation connect risk factors, and how this concept underpins portfolio risk, stress testing, and value-at-risk models. Section 1. The Big Idea. In risk management, we rarely deal with a single variable. Interest rates, equity prices, credit spreads, and foreign exchange movements, all of these fluctuate together. A multivariate random variable is a way of describing several uncertain quantities at the same time, while capturing how they depend on each other. In simple terms, think of it as a bundle of random variables that share a common story. When one variable changes, the others might change with it, and we need a framework that captures this relationship. That framework is the joint distribution of the variables. Every univariate random variable has its own distribution. But in reality, risk factors are rarely independent. That's why risk managers study their joint behavior, using multivariate distributions to estimate exposure across different parts of a portfolio. Section 2. Joint, marginal, and conditional distributions. Let's start with the three core building blocks: joint distributions, marginal distributions, and conditional distributions. The joint distribution shows the probability of all variables taking specific values together. For example, the probability that equity returns are positive while interest rates rise by 2%. The marginal distribution focuses on just one variable at a time. It tells you the overall probability of that variable, ignoring everything else. And the conditional distribution looks at one variable, given a specific outcome, of another. For example, what is the distribution of bond returns given that the equity market has dropped by 5%? Conditional distributions are powerful in scenario analysis and stress testing because they show how one part of the portfolio behaves when another is under stress. Understanding the link between these three distributions is the key to analyzing dependence in risk models. Section 3. Independence and dependence. Two risk factors are independent if knowing the outcome of one tells you nothing about the other. But in finance, true independence almost never exists. Most variables are dependent in some way, often through economic links, behavioral effects, or market contagion. If the joint distribution equals the product of the two marginal distributions, then the variables are independent. If not, they are dependent. However, here's an important warning. Zero correlation does not mean independence. Correlation measures only linear dependence. Two variables can have zero correlation but still be nonlinearly dependent. For example, if one variable represents returns and another represents the square of those returns, correlation may be zero, but the relationship is clearly not independent. This is why good risk models go beyond correlation and why multivariate modeling is essential. Section 4. Expectation, variance, and covariance. Now let's talk about moments, the statistical measures that describe the behavior of random variables. The first moment is the expected value or mean. The second moment is the variance, which measures how widely outcomes spread around the mean. When we extend this to multiple random variables, we need one more concept: covariance. Covariance measures how two variables move together. If the covariance is positive, they tend to move in the same direction. If it's negative, they move in opposite directions. But covariance depends on the scale of the variables, so we often use correlation instead. Correlation standardizes covariance and always lies between -1 and +1. A correlation close to 1 means the variables move almost perfectly together. A correlation near 0 means they move independently. and a correlation of -1 means they move in exact opposite directions. These relationships are summarized in what's called the covariance matrix. This is a square table showing all variances and covariances among the risk factors in your model. Every risk manager should know how to read and interpret this matrix, because it defines how total portfolio risk aggregates. Section 5. Variance of a portfolio or weighted sum. Now we connect this to the real world of portfolios. If you have two risk factors, x1 and x2, the variance of their sum equals the variance of x1 plus the variance of x2 plus twice their covariance. That third term, the covariance, determines how diversification actually works. If the two assets are highly correlated, their covariance is positive, and diversification benefits are minimal. If they're negatively correlated, the covariance is negative, and diversification reduces portfolio risk. For a weighted portfolio, the same idea applies. The variance of the portfolio equals the weights multiplied by the covariance matrix, and then multiplied by the weights again. This is the core of portfolio variance and value at risk calculations. Understanding how covariance and correlation drive that total variance is what separates basic analysts from professional risk managers. Section 6. Linear transformations and scaling effects. When we apply linear transformations, for example, scaling or combining risk factors through exposure weights, the expected values and variances transform predictably. Scaling by a constant multiplies the variance by the square of that constant. Adding a constant has no effect on the variance. These properties allow us to build risk models where exposures are combined linearly, and we can trace exactly how each factor contributes to total variance. This principle underpins everything from factor modeling to sensitivity analysis and risk attribution. Section 7. Continuous multivariate random variables. Up to now, we've discussed discrete cases where probabilities are listed in tables. In practice, most financial data are continuous. So instead of probability mass functions, we work with probability density functions, or PDFs. The same rules apply. We simply replace sums with integrals. The joint density function gives the likelihood of combinations of outcomes. The marginal density comes from integrating the joint over one variable, and the conditional density is the ratio of the joint density to the marginal of the conditioning variable. For example, in a two-asset model, you might integrate the joint PDF of stock and bond returns to get the marginal distribution of stock returns. Or you might compute the conditional distribution of bonds given that equities fell by a certain amount. These operations allow continuous modeling of joint risk, crucial for simulation-based methods like Monte Carlo. To Section 8. Correlation, diversification, and portfolio risk. Now let's bring this into portfolio theory. Correlation determines diversification. Low correlation between assets creates diversification benefits. High correlation erodes them. When correlations rise, as they often do during financial crises, portfolios that looked diversified suddenly become concentrated. This phenomenon explains why diversification often fails when it's needed most. For that reason, advanced risk models stress test the covariance matrix itself. They ask, what happens to total portfolio variance if correlations double? This scenario-based approach helps identify hidden vulnerabilities in a seemingly diversified portfolio. Correlation is also central in credit portfolio models, market risk aggregation, and enterprise risk frameworks. Understanding how dependencies shift across time or under stress is one of the most valuable skills for a professional risk manager. Section 9. Conditional expectation and conditional variance. Another important tool is conditional expectation. It's simply the expected value of one random variable given that another takes a particular value or falls within a certain range. In practice, We use conditional expectations to estimate expected losses given a stress event. For example, what is the expected portfolio loss given that the equity market declines by 10%? Similarly, conditional variance tells you how uncertainty changes under specific scenarios. When conditioning on a stress factor, conditional variance often increases, highlighting concentration and hidden tail risks. Conditional expectations are the mathematical foundation behind stress testing, sensitivity analysis, and risk scenario generation. Section 10. The independent and identically distributed case. Finally, many models assume random variables are independent and identically distributed, often abbreviated as IID. This assumption means each variable comes from the same distribution and none of them influence the others. It's a clean starting point for theoretical work, such as the central limit theorem, but in finance it's rarely realistic. Markets evolve, correlations change, and shocks spread quickly across assets. That's why modern risk frameworks replace the IID assumption with explicit correlation structures or copula-based models that can handle tail dependence. Section 11. Real-world application example. Let's ground this with a simple risk example. Imagine you manage two exposures, a foreign exchange position and an interest rate position. The standard deviation of the FX position is 2%, and that of the interest rate position is 1.5%. Their correlation is 0.6. That means their covariance is 0.00018. If the portfolio is 70% FX and 30% interest rate, the portfolio variance equals the weighted combination, 0.7 squared times 0.0004 plus 2 times 0.7 times 0.3 times 0.00018 plus 0.3 squared times 0.000225. The result is approximately 0.000292, giving a portfolio standard deviation of about 1.7%. If you assumed independence, the variance would be only 0.000216, or about 1.5% standard deviation. That means ignoring covariance underestimates total risk by roughly 15%. That's the cost of ignoring dependence. That's the power of multivariate analysis. Section 12. Practical takeaways for risk managers. Here are 5 takeaways you can apply right now. 1. Never assume independence. Always test relationships between your key risk factors. 2. Monitor correlation behavior over time, especially during market stress. 3. Use multivariate distributions or copulas to capture tail dependence beyond simple linear correlation. 4. Remember that diversification works only when covariances remain stable. And 5. When reporting risk to management, always show not just marginal risk numbers, but joint risk metrics, such as portfolio variance, stress-based conditional losses, or value at risk that captures co-movement. These insights will elevate your risk analysis from basic measurement to real risk understanding. Section 13. Closing summary. To wrap up, multivariate random variables give us the language to describe how risks interact. They link marginal, joint, and conditional distributions into one coherent framework. Covariance and correlation capture the essence of dependence, and understanding those relationships is essential for accurate risk aggregation, portfolio diversification, and stress testing. Mastering this concept means you don't just measure risk, you understand how it behaves together. Thanks for watching the Risk Manager's Corner. If you found this breakdown helpful, hit like, subscribe, and stay tuned for our next episode, where we'll explore multivariate loss distributions and tail dependence in practice.